Effective strategies for hedging the banking book. Hedging the banking book is essential for financial institutions to manage risk and maintain stability in their operations. In this video, we will explore some effective hedging strategies that banks can implement to protect their banking book. 1. Interest rate swaps. One of the most common hedging strategies for banks is using interest rate swaps. By entering into an interest rate swap, banks can exchange their variable rate assets or liabilities for fixed rate ones, or vice versa. This helps to mitigate interest rate risk by locking in a fixed interest rate or obtaining a variable interest rate. 2. Options. Options provide banks with the right, but not the obligation, to buy or sell an asset at a predetermined price. Banks can use options to hedge against potential losses or fluctuations in asset prices. For example, a bank may purchase a put option to protect against a decline in the value of its portfolio. 3. Futures contracts. Futures contracts are agreements to buy or sell a specific asset at a predetermined price on a future date. Banks can use futures contracts to hedge against changes in currencies, interest rates, or commodities. For instance, a bank may enter into a futures contract to hedge against currency exchange rate fluctuations. 4. Portfolio diversification. Diversifying the banking book is another effective strategy for hedging risk. By spreading investments across different types of assets, sectors, and regions, banks can reduce their exposure to any single risk. Diversification helps to stabilize the banking book and minimizes the impact of adverse events. 5. Duration matching. Duration matching involves aligning the duration of assets and liabilities in the banking book. This strategy aims to reduce the risk arising from changes in interest rates. By matching the cash flows and maturities of assets and liabilities, banks can minimize potential losses due to interest rate fluctuations. 6. Stress testing. Stress testing is an important tool for identifying vulnerabilities and evaluating the resilience of the banking book. By simulating extreme scenarios, banks can assess their ability to withstand adverse market conditions. Stress testing helps identify potential risks and enables banks to take proactive hedging measures. 7. Swaptions. A swaption is an option to enter into an interest rate swap. It provides banks with the flexibility to execute an interest rate swap at a later date if certain conditions are met. Swaptions can be used strategically to create additional hedging options and manage interest rate risk more effectively. Implementing these effective hedging strategies can help banks hedge against various market risks and protect their banking book. It is crucial for banks to carefully analyze their risk exposures and develop a comprehensive hedging strategy that aligns with their risk appetite and business objectives. Want to learn more? Claire Trithel on LinkedIn